Fastly stock just exploded more than 70% in a single day. 76%. And if you're a retail investor watching this move, you're probably thinking, what just happened? And is it already too late? This wasn't a meme squeeze. This wasn't random hype. This was earnings. And what Fastly just reported may have completely changed the story around this company. Let's break it down fast. For years, Fastly has been one of those almost there tech stocks. Big potential, cloud infrastructure, edge computing, content delivery, but no consistent profits. Wall Street basically said, prove it. This quarter, they proved it. Fastly reported 12 cents per share in adjusted earnings. Analysts were expecting just 6 cents. They didn't just beat expectations, they doubled them. Revenue also came in strong, growing over 20% year over year and beating Wall Street estimates by a wide margin. Now, normally, a beat like that gives you maybe a 10 or 15% move, not 76. So what really lit the fire? This surprised Wall Street. It wasn't just the quarter, it was the guidance. Fastly told investors that 2026 revenue is expected to come in way above what analysts had modeled. We're talking about a full-year outlook that crushed consensus numbers. And earnings guidance? Nearly double previous projections. That's not small improvement. That's acceleration. When a company raises forward expectations this aggressively, especially after years of struggling, the market doesn't just react, it reprices the stock. And that's exactly what happened. Now pay attention to this. For the first time ever, Fastly achieved a profitable year on a non-GAAP basis. That is a psychological shift. Investors treat profitable tech companies very differently from unprofitable ones. The company swung from a loss last year to solid net income this quarter. Margins expanded significantly. Gross margin jumped into record territory. That tells investors something critical. This company is scaling efficiently, not just growing smarter. And then there's the AI angle. This surprised Wall Street. Fastly is now being called an underappreciated AI play. Why? Because of something called agentic AI traffic. As large language models and AI systems browse the internet, pull data, and synthesize information, that creates massive network demand. All that AI activity needs infrastructure. Fastly's edge network sits right in the middle of that traffic flow. More AI usage means more data moving through their platform. More data means more revenue. Investors suddenly realized Fastly isn't just a content delivery company. It's quietly becoming part of the AI infrastructure layer. And in this market, anything tied to AI gets attention fast. Here's another key piece. Enterprise growth. Fastly's enterprise customer count increased again. But more importantly, existing customers are spending more. Their net retention rate improved to 110%. That means customers aren't leaving, they're expanding, and their backlog of contracted future revenue surged dramatically. That gives visibility, not hype, visibility. So let's connect everything. Big earnings beat, strong revenue growth, first profitable year, major margin expansion, bullish 2026 guidance, AI-driven traffic tailwind, analyst upgrades and raised price targets. When all of that hits at once, you don't get a small bounce, you get a revaluation event. But here's what could happen next. After a 70% single-day surge, volatility is almost guaranteed. Short-term traders may take profits. Momentum players may rotate out. The stock could cool off in the near term. But if Fastly continues executing, if margins keep expanding, if AI traffic truly becomes a long-term driver, this might not be the end of the move. It could be the beginning of a new phase for the company. The key questions retail investors should watch now are simple. Can they sustain profitability? Can enterprise spending keep rising? And does AI traffic continue accelerating? Because expectations are now much higher, and higher expectations mean less room for mistakes. Zoom out for a second. The market right now is rewarding companies connected to AI infrastructure. Even indirect exposure is getting re-rated quickly. Fastly just entered that conversation in a big way. The narrative has shifted from struggling edge network to profitable AI infrastructure beneficiary. That's a major difference. If you were holding before earnings, this was one of those rare portfolio-changing days. If you weren't, now you're facing the classic investor dilemma. Chase strength, wait for a pullback, or stay on the sidelines? One thing is clear, this wasn't random. It was earnings strength, forward guidance, profitability, AI momentum, and institutional upgrades, all hitting at once. Fastly didn't just rally, it changed its story. Now I want to hear from you. Do you think Fastly is becoming a real AI infrastructure winner, or is this just another overreaction that fades? Drop your thoughts in the comments. And if you want fast, simple breakdowns on explosive stock moves like this, make sure you're subscribed. Because when stocks move 70% in a day, you need to know why.